Most people think that the Golden Age of Aviation was the 1980s. It's a fair assumption to make, but in fact they're wrong. It's 2026. It's planned to be the biggest year in aviation history, except there's one catch. Planes are fuller than ever, global load factors have hit record highs of 84%, and for the first time in history, the aviation industry is forecast to break the $1 trillion revenue mark. It's a staggering milestone, but to put this $1 trillion into perspective, we have to look back at the last great era of aviation growth, which is the 1980s. It was the golden age. We had expansion, deregulation, we had the rise of the jumbo jet, but there's one massive difference between the 1980s and today. Back then it was driven by novelty and luxury, it was extremely exclusive, whereas these days it's more seen as a utility or a necessity. Back then a 70% load factor was seen as a massive success, whereas these days if airlines aren't cracking that 84% load factor, the math just doesn't math anymore. We've moved away from an era where flying was an event to more of an era where it's an essential circulatory system of the global economy. Global air travel has reached another record where annually we're seeing 5.2 billion passenger journeys. And while the world is growing at 4.9% a year, one market is absolutely leading the pack, and that is the Asia-Pacific market. It's growing 50% faster than the rest of the world, and really APAC or Asia-Pacific is the primary engine for global aviation growth for the next decade. But to understand why this is happening, we first need to zoom out and look at the fuel behind this growth, and that is the immigration engine of 2026. In 2021, Australia's migration was minus 85,000 people. Fast forward 2 years later, and it's plus 500,000 people. This is the immigration engine that is making Australia's aviation industry recession-proof. Just 5 years ago, Australia's migration numbers were a negative figure and they were struggling. Fast forward to 2023, this figure had increased by 180% from their pre-pandemic levels to 548,000 net new migrants per year. While this figure has pulled back slightly, it's forecast to continue at about 240,000 people per year through to 2036. To understand why 240,000 new migrants is so significant, we have to look at the historical baseline. So from 2010 to 2020, Australia averaged around 218,000 people a year. So when we project 240,000 people a year as the new normal, we're not just seeing a bounce back, we're actually seeing a permanent 10% increase in the growth rate of the country compared to the last decade. This means that by 2036, there's going to be 4 million net new migrants, contributing to census data showing that over 32% of Australians will either have been born overseas or are first-generation Australians. So what does this have to do with aviation? The reason is VFR, visiting friends and relatives, and it's an aviation business term that basically means, unlike holiday travel, which is far more sensitive to price change and inflation, VFR has a very, very low elasticity of demand, which means people see it as a need. They're not wanting to travel overseas, but really they need to go and see their friends and family once or twice a year. And it's not just the newly arrived Australians either. What we're seeing is a compounding legacy where migrants who might have moved to Australia in the 1980s or the 90s, their families are now much larger. They're wealthier and they're flying more often than ever before. The real kicker here is going to be, where exactly are these migrants coming from? And the explosive economic growth that's happening right now amongst our northern neighbours. In Chapter 3, we talk about the Asia-Pacific engine. There's a magic number that determines exactly when a country is going to start buying plane tickets. It's called the Aviation Threshold, and 1 billion people are about to cross it. One region is forecast to absolutely crush the records for air travel over the next decade. It's been labelled the 20-year triple, and it's happening right now in Australia's backyard. If I quoted you 7.2% annual growth rate for revenue, you'd probably assume that I'm talking about Silicon Valley, tech companies, space systems, but incredibly, that is the Asia-Pacific passenger revenue forecast for the next decade, and it's roughly 50% higher than the rest of the world. So why is this market segment growing at such a gangbusters rate? And really it boils down to the Asia-Pacific being the global epicenter of population. And by 2034, it's forecast to have 1 billion middle-class households. That's roughly 64% of all middle-class households in the world, and it's going to be 8 times the size of the US. We're seeing this play out in real time. In Vietnam, 50% of the population is now middle class. In India, outbound travel jumped 19% in 1 year. And to understand why this impacts demand, we need to understand the aviation threshold. So this is an income level of approximately 20,000 US dollars, and that's in purchasing power parity, triple P. And this is a critical threshold where households transition from essential spending to discretionary spending, of which air travel typically sits very high on that picking list. So we have 1 billion households that are crossing the threshold. The money's there, the desire to travel has never been higher before, but there's a $1 trillion question facing the industry. To keep pace, the industry is going to require 2.1 million aviation professionals by 2034. With half of today's workforce expected to be retired or leave the industry by then, the shortfall that the industry is facing is 1.5 million people. In Chapter 4, we're going to investigate the workforce machine. An airline makes less profit per passenger than what I can make selling this iPhone case. Welcome to the growth trap of 2026. The recruitment reality is this. To sustain the 20-year triple, the Asia Pacific region alone is going to have to recruit 500,000 new aviation professionals by 2036. Our current regional workforce stands at about 480,000 people, which means that essentially we have to double our professional personnel in the next decade, whilst fighting off the retirement cliff that's going to claim about half of our pilots and technicians in that same period. This creates what I call the growth trap, where Asia Pacific traffic is growing at 7.3%. Obviously, airlines are very tempted to front run this curve, ordering hundreds of planes and hiring aggressively to capture that market share. But this comes with extreme risk. Airlines globally run at extremely thin margins, around 3.9%. This is the danger zone, and on a per passenger basis, you're looking to profit about $7.90 US. That's less than the price of an iPhone case. And because aviation is so cyclical and capital intensive, that 3.9% offers very little shock absorption when there's a downturn. So overexpansion just before an economic downturn can send a mid-tier, reasonable airline into bankruptcy within a matter of months. Every 1% of fuel saved, whether it's through RNP AR approaches, which I've spoken about in a previous video, or engine out taxiing, or anything that increases fuel efficiency or general operating efficiency, that directly increases that 3.9% margin that the airline's operating under. And this effectively becomes a shield, and it enables the airline to have more financial tolerance, and they can take more risk when required. And that's what's needed to capture market growth. So in 2026, what we're seeing is that the industry is playing a game of inches, and the airlines who understand the workforce machine are probably going to be the ones who are positioned to lead the next decade. Thanks very much for watching, and I'll see you on the next one.